All right, welcome. In this video, we're going to talk about $589,000 of stocks that I'm buying, and I'm going to be telling you what they are and what I bought. I already did it. This portfolio right here, what we're talking about with the 589,000 is going to be with retirement, with my retirement account. So in the last video, I showed what I had before. I sold out of that account because I need to switch it over for some administrative reasons. And now I'm buying again, but I'm not buying the same stuff. Do you want to learn a bit about the basics of retirement accounts with 401ks, IRAs, Roths versus traditional, which ones I'm leaning towards, and maybe which ones you might think about doing too? Go ahead and click the card above. But right now, what we're going to talk about is what I'm buying in the new retirement account that I have. So we've deployed $589,000 into two ETFs. Surprise, surprise, if you watch my channel, you know I'm big on ETFs. Sure, I'm big on certain stocks that I really understand and believe in, but you know that ETFs, like I got some ETFs, right? So that is what I have a lot of my longer term holdings in. So let me show you what I bought. I'm actually not going to be sticking with just these two ETFs, but right now it's just a two stock portfolio, a two ETF portfolio. I'm also going to be showing you how you can build your own portfolio with ETFs. It's a super simple way. It's called the lazy ETF. I'll show you that and maybe what might be better suited for you in your time horizon. So let me show you just straight up what I got so you can see, and I'll talk about the percentages and what I'm actually going to be doing because I'm not going to be sticking with this. What I first did is I wanted to get into the market, so I had to sell out from one account, move it over to another account for administrative reasons, and so I wanted to get into the market. I don't like missing days in the market. So what I've done for now is I've moved into VTI and VXUS. Now, my last portfolio was VTI, VXUS, and BND, which is my bond allocation. Getting rid of the bond allocation, I'm going heavy into stocks, as in 100% heavy into stocks, because I got a long time horizon. And so I'm fine with the extra volatility, and I'm willing to get that extra 1 or 2% of potential gains by not having, a 20% bond allocation, for example. So here we go, VTI, VXUS. VTI is the total stock market. You buy this just like any other stock. It's an exchange-traded fund, and boom, you own thousands of stocks, essentially. You own the entire U.S. stock market, and if Apple goes up, guess what? That portfolio goes up a little bit. If Cisco goes up, that goes up. If Johnson & Johnson goes up, that goes up. It evens out some losers, and overall, it gives you a really diverse and really strong portfolio. Next is VXUS. This right here is my international holdings. So I have 20% in this. 20%, which is in the international stock market with thousands of companies, and it excludes the US market. That's why it says ex-US, because I don't need to buy any more US. Now, I could have done this exact same thing just by buying something called VT. VT is the total stock market in the world. So I could have done that, but I want to control my US to international allocation percent. And what I decided was 80% US with VTI and 20% VXUS. So it ends up being 471K and 117 for that 80-20. Now, I'm actually going to be changing this to a little bit more aggressive, even more aggressive. Now, before I kind of explain to you that, I want you to get an idea of how to create a well-rounded portfolio with ETFs. And you can do this and have completely different ETFs than me, and I'll still say, maybe that's great, right? And let me show you the platform that I would use to kind of create this ETF allocation. So before you go into that, I wanted to cover the basics of the retirement account because it's different. So as we go and talk about these different kinds of strategies for buying and selling, let's kind of go over the basics. The basics are, in your retirement account, you have no capital gains. That is the essential benefit of a retirement account. You don't pay interest and tax on the gains of your account. Now, there's different ways to kind of look at this, right? You can pay taxes in the beginning with a Roth, or you can pay taxes at the end with a traditional IRA. That is a wash. So that's a complete wash if you pay taxes now or pay taxes later. I don't understand why people still get confused with this, even at really high levels. You'll find some of the best YouTubers out there, kind of getting confused with the benefits of tax deferral. There's no real benefit if you're taxed at the same tax rate now compared to later. Sure, you might want to think, maybe later I'll be retired, I won't be making as much, so my tax bracket will be lower. In that case, you want to go for a traditional. Or you might be thinking, you know what, with climate change, with how things are going and politically, with how we're just going more and more into debt, maybe tax rates will be even higher in the future, which I unfortunately am on that, leaning towards that side. And so a Roth might make more sense where you pay taxes now. You don't pay taxes in the future. I also don't plan on like being broke in the future. Like I plan on having investments that are paying me. So I don't plan to be in a low tax bracket. But for a lot of people that work maybe a traditional job and aren't really investing, then you got to decide what's right for you. But the benefit of all this is you don't pay on the capital gains. The next thing to kind of realize is you have a really long time horizon. If you're young, if you're watching this and you're 25 to 35, hit that like button so I know, and most likely you are if you're watching this channel. So you have a long time horizon, right? We're talking about like 25, 30 years. And if that's the case, then you also can kind of realize like you have the highest reward potential because you can have compounding work the most, but you also kind of have the lowest risk because you have the most time to kind of recover. So that's why I'm cool with being really heavy into the stock side. Now, if I was 50 years old and I want to retire in 10 years, guess what? This would not be my portfolio, not even close, right? I would have a much higher bond allocation. I would probably be somewhere like 50-50 if I had 10 years. Maybe less, maybe 30% stocks and 70% fixed income. So this has to be right for you. So let's go into these different portfolios because I think these are pretty cool. Right here is the Lazy Portfolio ETF.com. Check it out. It's a pretty cool site. Tons of ads, really annoying, but hey, it's a really cool site because it breaks down some of the ETFs that have performed the best. So a 10-year annualized return of 21% if you just bought one ETF. 10 years at 21%. The law of 72 says, hey, it'll double the percent. 72 divided by the percent. So that's crazy. So if we did that, let's see what that would make. Now, typically we see maybe like a 7% return, right? So if we take 72 and we divide that by 7, what we usually get is like a doubling every 10 years or so. I'm not sure if you can see that, but hey, 10 years or so. Now with the 21%, when we do a 72 divided by 21, we can get a doubling in 3.4 years. That's crazy. 3.4 years. So let's say this stayed true, which is very unlikely, but hey, for all intents and purposes, have 100K. In 3 years, it's 200K. In 6 years, it's 400K. In 9 years, it's 800K. In 12 years, it's 1.6. And this is where it gets fun, in 15 years, it's 3.2. In 18 years, it's 6.4. In 21 years, it's $12.8 million. That's insane. Now, that's really high. Will these things keep up? You should not look at it like, hey, this is the best one because it's the highest. What you should know is that this is the highest, and so it's the most expensive. So let's try to frame our mind like that. But be careful when you look at these kinds of numbers. But the Warren Buffett portfolio, which is pretty much kept for a long old time, 80 years, has done pretty well for him. This is an ETF that comprises of this is a portfolio of 2 different ETFs that you can basically copy. The US stocks did really well, and then you can own the entire US stock market. You want to know what that one is? That's VTI, right? VTI is the total US stock market. So if I just bought that and I just chilled, I'd be doing pretty good, 44% for the year. And that's what I've had in my other retirement portfolio. I had around 60% of this exact ETF. So you can go down these, check out the different ones. The orange is less risky than the red, makes sense, and then it gets to, I think, yellow and green. And these are really simple. Now, you can go stocks and bonds, 80-20. That is basically what I had in my other portfolio. It's an 80-20 stock and bond. And I had international as well that made up the stocks, but you can get more and more complicated and you can get into less and less risk as you go down here. What's really interesting to me is the stuff that's like really high returns with less risk, which is like, wow, Or you can do the opposite, right? Emerging markets has been kind of crap, and they're still really risky. But it's done well this year, but overall in the 10 years, it's not been doing too hot, 3%. So as we go here and we look at the 10 years, we can see them go up and up and up and up. Overall, the market might do let's say 7%. Since 1926, the market's done 10% if you just bought the S&P 500, which is VOO as an ETF. But you want to look at these and kind of think about your time horizon and what might be right for you. This is a really cool way to construct a portfolio. And this includes stocks, bonds, it includes gold, commodities, real estate. There's different ETFs for all of those. So you can check that out and make a decision what's right for you. What I've kind of decided for my portfolio is I like this idea of mostly being in these ETFs because over and over again, there are so many countless stories of how bad people have done. And here's a chart that goes, you suck. This is your average returns is right here. And then if you just bought a certain, like the S&P 500, you'd be right here, right? Here's the average of the S&P 500. But here maybe is the average of people who think they're investors and they're trading and they're trying to do all sorts of stuff to beat the market, and almost all the time they don't. Also, the danger of trying to beat the market is there's a good chance you're holding a lot of cash, because you're selling and you're waiting for your moment. And so that cash is giving you a 0% return as you wait for the moment. So be careful with that. There's also this story that I don't think is true, but it's just everywhere. Fidelity has done a study as to which accounts have done best. And they found was that they were dead. Now this is, there's a lot of stories about this where there was some report, or maybe someone just at Fidelity one day said that the best portfolios that they've seen are the ones that are from dead investors, meaning people that are not investing, actually dead. In this article, he says, no, it's people that forgot they had an account at Fidelity. The people that don't invest and don't touch it have often done best. I talked to someone who was a big advisor, and he's like, yeah, some of my clients, I've looked into their accounts and they've just done nothing for 30 years, and now they have multi-millions in their account. And it's pretty crazy, but we are trained to do the opposite. Our brains are not meant to be in the stock market, right? When things go good, we think, hey, things are going to go to the moon. As things crash, we think, oh my God, this is the worst stock, instead of us thinking, you know what, this is cheap or this is expensive, which is the reality of when stocks are going down, they're cheap. When they're going up, they're expensive. So keeping this in mind, what I'm actually going to be doing as the stock market maybe makes a different cycle, if we see a pullback, I'm actually going to start buying into my really high conviction companies. So I might start buying some Tesla in the retirement account. I might be buying some Amazon. I might be buying some Apple. We'll have to see what comes down. But I'm a big believer in technology, right? And technology has, done the best in the last 10 years. And you know what? I kind of don't see it doing less than the best moving forward. Technology is eating the world, and every business that is any business, technology can help it grow, and the companies that are technology first are the ones that win. If we want to think about a business that is really just hasn't been changed for 100 years, you can think about the automotive business. The combustion engine has existed for over 100 years, and it's a kind of weird and inefficient market of how there's dealerships and no one likes going to the dealerships and haggling on a price that's not transparent, and going to the gas station and paying for higher gas, and there hasn't been a lot of innovation. Technology kind of sucks. You buy navigation on your car and it kind of sucks. You would rather use your phone. It's weird, but the industries that are the least efficient, the ones that have been just kind of clunking along for so long, those are the ones where there's the most opportunity. And when a technology company comes in, and like Tesla from Silicon Valley comes in and it's like, hey, here's full self-driving. Hey, here's an electric powertrain. Hey, why do we need dealerships? Let's just buy it online in one click with super transparent pricing. Once you start thinking like a technology company, your ability to overcome the competitors in any kind of business really grow. So I see technology growing. So I would like to start owning some QQQ, which is the actual holding that represents this 43% gain and 21% annualized. But man, I hate saying this, but but I might be waiting for a little bit of a pullback. Now, my plan is to hold on to these ETFs all the time. So I'm not selling out to wait for the moment to buy something else. But if I see something that I really believe in, really high conviction, I'm okay with going into it, knowing that, hey, I can, first of all, have no capital gain. So if I want to sell out of it, I don't have to worry about capital gains. That's the reason why I haven't sold some of my holdings. It's like, I don't want to have to pay taxes on that. But also there's this long time horizon. So I'm chill letting that thing recover if it gets hit, as long as I really believe in it. So that's why I want to maybe think about some high reward and low risk plays. I also want you to keep in mind a few trends that have just existed, like period. And these might be a shock to you, but value beats growth. So value companies with lower PE ratios and are not going crazy investing into themselves have actually done better over time than growth companies. I know that's different in the last few years and Tesla and yada yada, but value has beaten growth over time. Also, lower and mid cap has beaten large companies over time. The thing that I like about VTI is that VTI includes lower cap companies. Remember I said I use VXUS instead of VEUS? That's because I would rather have some lower and mid cap companies. And so those are able to capture the companies that might have a big run up. Whereas if I own just VOO, which is the S&P 500, I would have missed out on growth stories like Tesla, for example, that only got added into the S&P 500 at a price that is higher than it is now. Whereas VTI had Tesla when it was much smaller, right? Because this includes thousands of companies. Whereas if you're just going after large caps, you can miss those winners. And that's why it's also so powerful to have these ETFs that cover huge, broad sectors. So you can get really niche with these ETFs too, though. You can go into specific, there's like an airline ETF, there's an ETF on energy, there's ETFs on all sorts of things. But I encourage you, check out the Lazy ETF portfolio. And I'll leave a link down below because I don't think I'm even saying it right. And let me know if you like this video. Leave me a comment. I'll read it and respond. Click like, and I'll talk to you soon.